In 2008, the world faced the worst financial crisis after the Great Depression. What happened and how did it impact the global economy? It all started with US housing markets. Banks gave out loans to people with poor credit. These subprime mortgages were bundled into complex financial products and sold to investors worldwide. When homeowners couldn't pay their mortgages, the house of cards began to fall. Major institutions like Lehman Brothers collapsed, causing panic across global markets. Stock market plummeted, businesses failed, millions lost their jobs and homes. The crisis spread globally, causing a severe recession. Governments and central banks intervened with massive bailouts and stimulus packages to stabilize the economy and restore confidence.
The 2008 financial crisis reshaped the financial landscape, leading to new regulations and reforms aimed at preventing another catastrophic meltdown.
Though the road to recovery was long, lessons learned have changed our approach to financial risk and global economics.
Let's talk about the first derivative that we'll be discussing in this presentation. The first derivative is called a mortgage-backed security or an MBS. An MBS or mortgage-backed security essentially allows a bank to securitize and sell off its loan to other parties such as investors. Now, banks no longer had to make money the traditional way by collecting the interest payment from the borrowers. They can now issue out loans and sell it in the form of a security or mortgage-backed security to the investors. At this point in time, banks were no longer interested in making money the old way. Rather, they were more interested in issuing the mortgage-backed security. However, the problem arises when there were essentially no more good loans to be given out to borrowers. In this case, what the banks did was they started issuing as much loan to whoever applied for the financing, no matter if you have no income, no job or no asset. So this is what led to one of the biggest financial crises in the world, the GFC 2008. Now let's talk about the roles of derivatives in the global financial crisis. Naturally, after any financial crisis, people will start looking for a reason as to why the crisis happened. So in the case of the GFC 2008, there are some experts who contend that the GFC is caused by derivatives, and there are also opinions that say that it's not caused by derivatives, but rather the lack of regulation and also the malpractice of the banking sector. However, we are in the opinion that the global financial crisis is mainly attributed to the improper use of derivative, which is used to make as much profit as possible for the Wall Street, which caused the economy to collapse.
Collateralized debt obligation is a financial product where different types of debts are pooled together, such as loans, mortgages, or bonds. These debts are then divided into different tranches, each based on the risk level. Investors can buy into these different tranches, each of them offering a different risk-return profile. The payments from the underlying debts are passed through to the investors in the CDO according to the terms agreed in the CDO agreement. CDOs played a significant role in the global financial crisis. CDOs were highly complex and opaque, making it tough for the investors to know about the underlying risks. When the homeowners defaulted in their mortgages and when the housing market collapsed, the CDOs plummeted and triggered a massive financial loss across the financial system, causing a significant change in the whole global financial crisis.
Okay, so the third derivative used during the global financial crisis is credit default swaps, or CDS. So CDS is a financial instrument that functions like an insurance policy against default risk. So the buyer of a CDS will get compensated if the underlying asset, which is mostly loans, during the global financial crisis, goes bad. However, during global financial crisis, these credit default swaps didn't require an insurable interest between the buyer and the underlying assets. Therefore, anyone could have bought these credit default swaps, and they did. So it's like buying a fire insurance policy against your neighbor's house. Therefore, everyone started to buy these CDS instruments, betting that the underlying asset will go bad.
The value of CDS sold in the market far exceeded the value of the underlying asset covered in these instruments. When the underlying assets eventually failed, it caused a major financial institution at that time, AIG, to fall together with them.